Well, we mentioned it before, but today is the 6-month anniversary of the tariff crash low. The S&P 500 is up 35% since then. Our next guest says a return of volatility would not be surprising, but growth opportunities still exist. So let's bring in Hennion & Walsh Asset Management President and CIO Kevin Mon. Kevin, it's great to have you back here.
Thank you, Morgan.
On set. 35% gain in the S&P in 6 months. Who would have thunk it?
Who would have thunk it? But if history serves as a guide, investors have multiple reasons to be optimistic ahead. First, another anniversary. This current bull market is hitting its 3-year mark. And going back over the last 50 years, each bull market that hit its 3-year milestone continued to move forward from there with an average duration of 8 years. Perhaps we got another 5 years ahead. Second reason involves the Federal Reserve. Going back over the last 40 years, the Federal Reserve has cut interest rates on 8 different instances when they paused for 6 months or more, just as they did in September. Now, in half of those instances, the economy moved into recession. That's not our base case here. In the other half of those instances, the stock market moved higher by about 8% over the next 6 months and 15% over the next 12 months. So there are reasons to be optimistic ahead. But I wouldn't be surprised to see some more volatility ahead. When that volatility comes, money will come off the sidelines. It will prevent those short-term pullbacks from coming corrections. And I think we melt upward as we close the year of 2025.
Why do you think we haven't seen so much volatility as of late? Is it just because we're waiting for our next big catalyst?
I believe right now that the market is optimistic that the Fed's going to cut interest rates 2 more times this year. And the longer the shutdown takes, the more likely that at least we get another rate cut in October because they have no more data to operate upon. Secondly, we continue to hear more and more announcements about this AI infrastructure build-out. Even NVIDIA CEO Jensen Huang has suggested by the end of this decade, we could see $3 to $4 trillion in AI infrastructure investment. We're around $600 billion right now. That's a lot more money being spent ahead. So if you're looking to follow the money, look to lean into AI infrastructure plays and maybe even some aerospace and defense plays.
Kevin, what does it mean to you in this market that good news seems to matter so much, especially if it's coming from the mouths of Sam Altman or Jensen Huang, but the bad news doesn't stick to the pen? It's like a Teflon market. I mean, is that a challenging or perhaps troubling signal about the optimism, or is it a sense that the market can power through?
Over the short term, I believe it's a sense that the market can power through. Over the long term, I see reasons to be concerned. Look at the current valuations of the S&P 500 right now. They're both trading above their 5- and 10-year averages. We've had over 30 record closes this year, on top of 57 record closes last year. Investors shouldn't consider that type of growth to continue that much longer. But that doesn't mean there aren't growth opportunities underlying these markets. And I think if you continue to follow the money, as I mentioned earlier, you're going to find those pockets of growth opportunities. But now may be the time, John, to diversify and look to some of those undervalued areas of the market. Healthcare is one of them. But I don't believe it's large cap pharmaceutical that you want to lead into. You want to lean into smaller cap biotech because M&A activity is going to pick up there as large cap pharma continues to get hit by headwinds of price controls and also patent expirations.
That feels dangerous, though, Kevin, in a market where the small caps have not responded the way so many have hoped or expected, where bigger's been better. And even if you look outside of stocks, real estate is in short supply and at valuation highs. Gold is trading above 4,000. The diversification pipelines of the past just don't seem to be available in the same way.
And another area to look at for diversification, though, John, is bonds. One area of bonds right now, municipal bonds, have underperformed other fixed income asset classes year to date. But that's because so many municipal issuers rushed forward with new issuance because they were fearful that the tax-exempt provision of municipal bonds would be taken away in the One Big Beautiful Bill Act. That wasn't the case, and now we're seeing less supply ahead. And I don't care what the asset class or what the security type is, anytime there's less supply and increasing demand, prices are going to move higher. So bonds may be a good area to diversify into, in addition to international stocks, which continue to outperform U.S. stocks, even though no one pretty much is talking about them.